How long the support and resistances are valid is one of the questions that I get repeatedly. Recently, someone asked me if a reference, let's say like this, HVN forms, and then market trades for a few months after that, and let's say market comes back to the same reference. Why is it still valid after so many days, so many months, so many weeks, or after so much of time has elapsed? He says that let's say someone is buying here and the market goes up. Have these buyers not sold here, no, wherever they get a good opportunity to sell? Let's say if the buyers here have already sold, then why when we come back to it, the HVNs, they tend to provide support or resistance? And I'm saying tend to, it is not guaranteed. We assume that HVNs will provide support and resistance, and then base our trading decision on that. And if they do not, then we make necessary changes to our trading decision. You need to understand that. Let us try and understand the concept of time frames, which is very crucial for you to understand if you want to answer this question. Now, every HVN that you see on this chart definitely is a struggle between buyers and sellers, and then you see that struggle resolving either to the upside in so many of these cases or to the downside in some of these cases. So what does that mean? It means is that someone who bought here and the market resolved to the upside was in profit. The buyers got better of the sellers, or in other words, the buyers absorbed all the sellers, no more sellers were there, and then the auction went higher to find more sellers. And it continued to move higher till it matched the buyers. And then the auction reversed, because then sellers got the better of buyers. The concept of time frame is important because let's say someone who's buying here is a mutual fund, and that mutual fund buys for long term. They are not buying to sell. They are buying to invest in, say, a 3-year cycle, 5-year cycle, whatever is their duration. Or maybe if it's an index fund, it's just buying to hold because they want to mimic the index. Now, let's say the market comes back to this reference, and the mutual fund analysts, they analyze the markets, they analyze the stocks, they analyze overall economic conditions, and then they find out that all are roughly the same, maybe a little less better or a little more better than what the condition was when they originally bought here. So here they may have some analysis. If it is the same or better, it is actually a no-brainer that they are going to buy it here. And if it is a little less better, maybe they will hold on to see what the market does. And if it is absolutely worse, then they won't buy here. And the market won't respect this support, and the market will break down. Now, this can be mutual funds, this can be big institutions, this can be so many different people who have to buy stocks for the long term. This can even be retail traders or retail investors who are buying for the long term. So, if your time frame is, let's say, 5 years, or you're just a buy and hold kind of a guy, now you are not going to sell every time the market comes down. In fact, you're looking for opportunities to buy. So let me show you an example of this a little while ago. Let us look at this example. And you see this HVN, and what happens? Market goes higher after that, and then market slowly corrects down, comes to this HVN, buyers show up again, buy, and push the auction higher. Why? Because they originally bought here. They expected the prices to go much higher from these levels, but yes, short-term cycles are there in the markets, and then some selling came in or profit booking came in, market went lower, only to provide these guys another opportunity to jump in and buy. This is the daily chart. Now, if I show you the weekly chart, you can see it happening on even longer term. So, see, I am talking about this consolidation, lot of consolidation. Now, when the consolidation is happening, we are really not sure whether the buyers are strong or the sellers are strong. It's only after some kind of follow through that we know that, okay, in this case, the buyers were strong. And see, 17, 18, 19. So it's almost 3 years later, you come back to the same zone. What happens here? Buying comes in and it pushes the auction. So are you telling me that people who bought in 15 and 16, they held on till this whole rally and then the market came back down and then they again bought? No. These may have booked partial profit, these may have booked some profits. These may be the traders, and some of them might be like Warren Buffett, that they have accumulated their holdings at 8,000 and they expect the markets to go to say 25,000. So it's like 3 times the current market price. They're not going to sell. They're not going to sell here. They will be so happy when the market falls like this. Who gets scared here? If someone is an intraday trader, someone is a short swing trader, and the market falls like this, and let's say he has bought somewhere here, he is going to panic. Why? Because he is booking profits at shorter ranges, shorter profit targets, smaller profits. It's not like an investor who bought at 8,000 is just waiting for the index to reach 25,000, then he decides what to do. These are short-term traders. And when the market moves too fast, and most of the times against them, it jumps their stop losses, it goes well beyond their comfort zone, then they panic and then they sell. But these guys, they are still holding and they will again buy. So the reason why people will buy at extremely old references is based in the time frames that they are trading from. A shorter term trader will be worried about it, sick, but if it is a long term trader, it is a great opportunity for them to again pile on their positions. And again, remember, if they are really shrewd traders, they may have booked their profits on partial positions, and when it comes back, they are using these profits and the original position money to buy even more at the same rate. So let's say they started with 100 and they slowly, let's say, booked 60 shares and made profit. This is like almost 50% profit. So they come back down. So if they have sold 60 shares, they'll probably buy 90 again and plus their original 14. Now they have 130 shares when this goes back up. So this is how they would trade, and they can even use F&O. So many things can be done to make money on your portfolio passively, and then use that money when you are presented with a good buying opportunity. So that is the reason why extremely old HVNs still provide support and resistance. If you have more such questions, please put them in the comments below, and the next video I make will answer your question.